The story of how an equity-focused portfolio beat the market does not begin with numbers. It begins with a decision, made quietly in an ordinary living room on an early spring morning. The investor, a mid-career professional named Daniel, looked at his past year's statements and saw a familiar pattern, a scattered mix of funds, a few trending stocks, and a sense that performance never quite matched effort. What he wanted was clarity, something systematic, not emotional. That moment became the start of a disciplined equity strategy built to prove that patience and structure could outperform noise. Daniel did not chase rumors or headlines. Instead, he set one clear objective: to design a portfolio that grew faster than the broad market without crossing ethical boundaries or depending on speculation. His plan rested on three simple principles: focus on quality companies, maintain discipline during turbulence, and allow time to do its work. Those ideas sound simple, but they required commitment far stronger than the excitement of quick trades. He began by defining quality in measurable terms. For him, a company deserved investment only if it showed steady revenue growth, low debt, strong cash flow, and a history of reinvesting profits responsibly. That removed nearly half the market at once. What remained were firms with real earnings and transparent leadership, businesses that produced goods and services people genuinely needed. He also refused to engage in margin trading or any product that created value purely from interest. Every dollar had to be tied to an actual productive asset. It was a moral boundary and an economic filter at the same time. When Daniel compared his refined list with the major index, something stood out. The index was filled with giants that moved with sentiment. His list was full of smaller, solid players that moved with results. To him, the difference looked like opportunity. He allocated 70% of his funds to these equities and left 30% in cash and short-term non-interest instruments for flexibility. Friends warned him that such concentration might be risky, but Daniel believed focus was not danger, it was direction. In the first few months, nothing dramatic happened. The market rose, dipped, and recovered as usual. His portfolio moved in quieter patterns, sometimes lagging, sometimes leading. What mattered was his behavior. Each week he reviewed performance against his written criteria instead of headlines. When a stock broke its debt discipline or diluted shares too heavily, he sold it. When another increased earnings while holding costs steady, he added more. The process felt almost mechanical, yet it carried calm confidence. This consistency slowly separated his results from the average. Media brought the real test. News networks announced market uncertainty driven by global supply issues. Many investors sold in fear, pushing indexes downward. Daniel's holdings also declined, but his reaction defined the difference. He revisited the financial statements of each company and found that most still produced steady income and maintained strong balance sheets. Nothing fundamental had changed except price. So he did what most investors found hardest. He held on. He even added small amounts to his best positions as values became more attractive. It was not a gamble. It was conviction built on homework. By the end of that turbulent quarter, the broad market recovered about half its losses. Daniel's portfolio not only regained full value, but stood 5% higher than before the downturn. That was the first measurable sign that his equity-focused method worked. The gain came not from guessing but from maintaining structure when others reacted emotionally. Over the next year, he continued refining the process. He set a quarterly review schedule, a strict rebalancing rule, and a written limit on how many holdings he could maintain. The limit forced him to choose only his strongest ideas. Every dollar invested had to justify its place. He also built a simple spreadsheet tracking dividend reinvestment, capital appreciation, and total return compared with the S&P 500. Each quarter he updated it without fail. As months passed, the compounding effect began to appear, while the index moved broadly sideways. His selected companies grew earnings faster than expected. They expanded into new markets, launched products, and maintained profitability without excessive borrowing. The reinvested dividends quietly added another layer of growth. By the 18th month, his total portfolio return reached 17% versus the index's 11%. That difference, though modest at first glance, represented the practical reward of discipline. Daniel's confidence increased, but he avoided arrogance. He knew that markets could surprise anyone, so he reinforced his rules instead of relaxing them. He read annual reports instead of news summaries. He avoided sectors driven by hype, staying with those built on tangible demands such as healthcare, energy infrastructure, and essential technology services. Each choice aimed to link ownership with real productivity. One evening, while updating his spreadsheet, he noticed a milestone. His account balance had crossed a level he once believed unreachable without complex derivatives or speculative trades. The data showed steady upward growth across every holding. He realized that the portfolio had quietly beaten the market not once, but for 3 consecutive quarters. The satisfaction came not from victory over others, but from evidence that method and patience truly worked. Observers might say his success resulted from perfect timing, but Daniel understood it differently. Timing mattered far less than behavior. He did not predict downturns or surges. He simply prepared for both. When prices fell, he bought quality at lower cost. When prices rose, he trimmed weight to maintain balance. This rhythm turned volatility from threat into opportunity, all without crossing moral or regulatory lines. The broader lesson extended beyond his own account. A disciplined, equity-focused strategy could outperform the market because it removed unnecessary noise and honored fundamentals. It replaced reaction with reflection. It relied on understanding businesses instead of chasing trends. Daniel's approach showed that long-term strength came from consistent application of clear principles, not secret formulas or speculative courage. At the end of 2 years, the records told a simple story. His portfolio delivered an annualized return of 12.8%, compared with the index's 9.6%. The variance may look small on paper, but over time that difference built real financial security. More importantly, every gain came from ownership of productive assets, not from interest-based instruments or questionable trades. His experience demonstrated that ethics and performance could coexist when guided by clarity, patience, and responsibility. As he looked back on that first morning of decision, Daniel recognized how quiet discipline had reshaped his financial life. The strategy did not promise excitement, it offered progress. It proved that an equity-focused portfolio could beat the market not through noise or prediction, but through structure, reason, and commitment to principle. The victory lay not in chance, but in choice's steady journey powered by understanding, rather than impulse. Months after Daniel confirmed his portfolio had consistently outperformed the benchmark, he faced a new kind of challenge, staying successful without becoming complacent. Many investors who outperform for a short period assume their insight will last forever. Daniel refused to believe that. He viewed the next phase as a test of maturity, whether he could preserve discipline. When things were finally working, he began with reflection instead of celebrating gains. He asked what had truly caused them. The answer was not one stock or a single event, but a chain of measured actions, quality screening, consistent rebalancing, and emotional control. Those were behaviors, not coincidences. They could be repeated if he stayed methodical. So he rewrote his investment statement into a living document he reviewed each quarter. It contained 3 pages of principles that guided every decision. Always verify data before opinion, never stretch valuations beyond reason, and accept smaller, steadier growth over dramatic swings. As markets entered a period of rising interest rates and corporate cost pressures, Daniel's patience faced another trial. Some high-growth firms began to slow, and financial media predicted an era of stagnation. The temptation to rotate into defensive assets grew stronger each week. Yet his screening process showed that several of his holdings still generated reliable cash flow. They were simply adjusting to new conditions. Instead of exiting prematurely, he trimmed only positions where debt levels rose too quickly. The rest he allowed to breathe. During those months, he studied the annual letters of respected fund managers who focused on equities through every cycle. He noticed a common theme. Long-term performance always came from ownership of real businesses, rather than reaction to short-term forecasts. That message reinforced his conviction. He built a personal habit before every trade. He would ask a single question: would I feel comfortable owning this company if the market closed? For a year, if the answer was yes, he continued. If not, he walked away. This small mental filter quietly improved his results more than any technical indicator ever had. As the economic environment tightened, valuations compressed. Many investors complained of flat returns. Daniel's portfolio also moved sideways for a while, but dividends continued to arrive, reinvested automatically into new shares. He realized that consistent reinvestment was a silent engine of compounding. It required no prediction and no special insight, only persistence. Over time, that persistence began to show measurable differences again. By the third year, his portfolio value had doubled from the starting point. It was not a straight line upward. It looked more like a staircase with pauses and climbs. Each step represented a phase where he resisted emotion and trusted fundamentals. When friends asked how he managed to stay calm during downturns, he answered with honesty by replacing emotion with evidence. Whenever he felt uncertainty, he read balance sheets until the noise faded. Numbers became his compass, not headlines. The fourth year marked a turning point. A wave of innovation in sustainable manufacturing created new opportunities across sectors he already understood. Several companies in his portfolio announced expansions using cleaner energy and efficient production models. Analysts debated whether these transitions would hurt profits, but Daniel recognized a pattern. Companies that adapt responsibly often build long-term resilience. He increased positions modestly, focusing on those that financed growth through earnings rather than debt. By year's end, his equity-focused portfolio achieved a total return nearly 40% above the benchmark over the same period. The difference came from holding onto solid businesses during uncertainty, while many investors moved in and out chasing short-term trends. Yet Daniel never described his outcome as beating others. He saw it as aligning behavior with logic. The market, in his view, rewarded process more than prediction. Success also brought a new responsibility: management of scale. As account size grew, transaction costs and tax considerations became significant. He began using tax-advantaged accounts wherever possible and organized his holdings according to time horizon: core positions for more than 5 years, satellite positions for tactical exposure under 2 years. This structure allowed him to plan without disturbing the foundation. He also diversified across industries to reduce concentration risk, while keeping focus on equities as the core engine. Around that time, Daniel decided to document his journey not as advice, but as record. He created a detailed spreadsheet that tracked entry prices, dividends, total yield, and benchmark comparison. Each cell told part of the story: the months of patience, the disciplined adjustments, the quiet confidence built on transparency. Reviewing the document became a ritual, reminding him that performance was simply the outcome of repeated correct behavior. Midway through the 5th year, markets faced another shock. Supply chain disruptions and sudden policy changes caused volatility unseen in a decade. Indexes swung sharply in both directions. Commentators predicted chaos. Daniel's experience from earlier cycles guided him. He reduced position sizes in companies whose earnings depended heavily on imported materials and increased exposure to domestic producers with strong pricing power. These moves were not reactions, but applications of research completed months earlier. By acting according to pre-written rules, he avoided impulsive trades that trapped many investors. When the storm passed, data revealed an interesting fact: the overall market had returned barely 2% for the year. Yet Daniel's portfolio produced nearly 8%. The margin widened again. Analysts might attribute this to sector allocation or timing, but Daniel knew it resulted from preparation. He had turned planning into a habit so deep that response became natural. He also discovered something more personal: a shift in mindset. Early in his journey, he used to check prices daily. Now he reviewed them weekly. Instead of measuring success by movement, he measured it by adherence to principles. This change reduced stress and improved decision quality. He no longer sought reassurance from external commentary. His spreadsheet and the company's financial reports provided enough truth. As wealth grew, Daniel considered his broader goals. He wanted his money to serve purpose beyond accumulation. Without using complex structures, he began allocating a portion of returns to community education programs focused on financial literacy. His reasoning was simple: Knowledge creates independence, and independence builds stability. Teaching others how to budget, save, and invest responsibly felt like a natural extension of his experience. During workshops, he often shared one central message: consistent equity investing built on ethics and data can outperform speculation. Participants were surprised that his approach avoided complex derivatives or aggressive trading. He explained that simplicity combined with discipline was powerful because it removed confusion. By focusing only on businesses that produced clear value, an investor could sleep peacefully and still achieve strong results. Another insight emerged during those sessions. Many attendees equated success with taking higher risk. Daniel clarified that true risk came from ignorance, not from volatility itself. When you understand what you own and why you own it, price swings become temporary noise. That perspective had guided his entire journey, and now he watched others adopt it with renewed confidence. As the sixth year began, Daniel reviewed his long-term performance. The compounded annual growth rate stood at 11.9% compared with the market's 8.2%. Over time, that small difference created substantial wealth. More striking was how stable his emotional experience remained. There were no sleepless nights, no desperate trades, only steady engagement. He realized that sustainable success required psychological balance as much as analytical skill. He began writing brief reflections after each quarter, not about numbers, but about mindset. One entry read, "Consistency is quiet power, noise is temporary drama." Another said, "The best portfolio is the one that lets you stay rational." These notes reminded him that investing was never purely financial. It was behavioral discipline performed repeatedly until it became second nature. By the seventh year, Daniel's system had become self-sustaining. Reinvested dividends and capital gains provided enough new capital to maintain growth even with minimal fresh contributions. He had effectively built a machine that generated progress through order. Friends who once questioned his restraint now saw his perspective. He never gave stock tips. He explained frameworks. His message remained unchanged: select quality, diversify sensibly, stay patient, and avoid shortcuts. In conversations with younger investors, he emphasized that beating the market was not about prediction, but about preparation. Markets reward those who plan when others react. Data supports this truth year after year. Portfolios grounded in strong fundamentals and consistent review outperform those driven by impulse. Daniel's story was living evidence of that pattern. As time passed, his portfolio weathered several economic cycles, from expansion to contraction and back. Each phase tested his principles, and each time they held firm. When prices rose too fast, he trimmed positions to preserve value. When pessimism dominated, he accumulated more shares of resilient companies. The discipline of rebalancing converted volatility into advantage over a decade. This behavior produced compounding far greater than most investors imagined possible. Without high risk, near the end of that decade, Daniel took a quiet evening to review the earliest entries in his spreadsheet. He saw the first modest investments, the early struggles, the moments of doubt. The numbers told a powerful narrative. Patient equity ownership grounded in ethics had consistently surpassed the benchmark through diligence, not fortune. It was never about beating someone else. It was about mastering oneself. He printed the final summary page and placed it beside a framed quote on his desk: "Progress is built on clarity, discipline, and time." That single line summarized every lesson learned. The market had given many fluctuations, but it had also offered education. He had discovered that wealth built on principle endures because it is protected by understanding. The closing thought of his journey reflected that understanding. Markets will always move in unpredictable patterns. Yet the investor who remains guided by reason rather than reaction can transform uncertainty into opportunity. An equity-focused portfolio built with clear rules, transparent selection, and moral boundaries does more than beat the market, it builds character. Daniel's experience proved that consistent effort directed toward genuine value creation leads not only to financial growth but to inner stability. His story ended where it began, in that same living room years later, surrounded by quiet proof that patience and purpose are the most powerful forces in finance. The screens no longer dictated emotion, they simply displayed progress earned through discipline. And in that calm silence rested the true victory of an equity-focused life, steady, transparent, and entirely within the boundaries of principle.